Stock's not going your way for the last week or two? Are you wondering if you should sell now to stop the losses? In this video, I will cover stock market crashes and what you should be aware of. Let's get into it. Welcome to Piece of the Pie with Ty. I'm Ty, and I appreciate you guys coming to check my channel out. If you like any of the content in this video, please hit that like button. It really helps me out with people finding the video, and subscribe to the channel. My channel is all about making sure people are aware of the different avenues there are to get a piece of the pie. Today we'll be talking about stock market crashes and what you should be aware of and what you should do. As you guys know, the stock market has been a little red for people for the past couple of weeks. What's going on is a market correction, or if you want to call it a mini crash. But we're going to get into what is a stock market crash. A stock market crash is a rapid and often unanticipated sudden drop in stock prices. A stock market crash can be a side effect of a major catastrophic event, economic crisis, or the collapse of a long-term speculative bubble. Often, stock market crashes are also driven by panic, by people selling because of some economic event going on. That could be the said cause of the stock market crash last year when COVID-19 had impacted the whole economy. So now that we know what a stock market crash is, what do we do? There's a few things that you can do during the stock market crash. But number one, first thing is don't panic. Being emotional is a good way to start racking up losses as a trader. If you don't know, trading has a lot to do with emotions and psychology. So if you get emotional because you see everything dropping and you panic, you might not make the best decision for you and your holding. So definitely keep a level head so you can make the best decisions for your portfolio and your trades. After you make sure you got your level head on, now you can do, of course, one of three things. You can hold, sell, or buy. Those are the three things that you can do during the stock market crash. You should hold your positions if you trust the companies that you invested into and you know that this isn't typically something that would happen to them. If you know your company and trust your company will probably bounce back, you should hold it. And also, if you are planning on keeping that company for your portfolio, you might want to hold them, because a lot of times if you hurry up and drop out of a company that you're going to be planning on going right back into, if you jump out of it, say you jumped out at the very bottom, now you're going to want to get back in and it might not ever hit that bottom point again. So getting out, it might defeat the purpose, because you might get out for a loss and then get back in once it starts going back up. So if this is a company that you really like and you trust and you really want to keep that position, you should just hold it. Especially if you trust that company and you plan on going back into it. You might not want to just jump out, because you could jump out at the very bottom of it and then next time you want to go in, it shot back up. Because typically stock market crashes do turn around. We just can't predict when they're going to turn around. So hold if it's a company that you like and you probably will be going back into. A hold might be something that you want to consider. You can also sell. If you sell, of course, you're going to take a loss and also stop your losses. But you mainly should sell if you are the type of trader that feels stressed out because you see these drops. Or you're the type of trader that don't want to hold a position for a longer term. Because if you do hold, that position might take a while to come back into the green. So if you don't want to make a position, a long-term position, and you want to stop the losses, you can sell. Main thing I say for people that are trading, know your risk level. So if you know that you are not going to feel comfortable with certain positions dropping a certain percentage, go ahead and sell and get out and stop your loss, because you can go back in. It's all about what's more important to you and what fits each of your trades. A lot of positions might be good long-term holds, so you might feel okay with holding it a little longer, but some maybe not. Definitely sell if you are taking on stress by looking at this drop. You don't want to be stressed out about your trading account. If you're stressed out, you need to pull out. You can also buy more. That's where that whole saying buy the dip comes from, because while these stocks are crashing, they are basically at the lowest that they've been in a while. So if you go in, you're gonna get a discounted stock price, and it'll pay off a week or two later when the stocks have jumped back up, because you got these stocks at a discounted price. Now, if you're gonna do this, of course, you're gonna have to make sure they're the companies that you believe in, and you can get them at this discounted price. And also, if you buy on top of the positions that you already have, you can average down. So say for instance, if you bought a stock at $10 and now because of this crash, it's at $4. All right, if you buy some of that share, it's gonna make your average. You bought at 10, so you bought some at 4. Now you're gonna go to your average might be 6. Depends on how much you buy, of course, but that's a way to average down, so it decreases what your losses look like in percentage. And if it was a great company, like I said, it's at a discounted price right now. So those are the 3 things that you can do. 3 things that you can do. It's all about what type of positions you have and what you feel comfortable with. Again, if it's companies that you really like, and if you sell them, you're just going to get right back in, maybe you should consider holding. If it's stressing you out that your account is in the negative, and it feels like you're bleeding and you don't know what to do, just go ahead and get out of the position. The stock market is always going to be there, and you're just going to be getting out with your money. It might take a loss, but if it's causing you stress, just go ahead and sell and get out. Or you can buy more and get stocks at discounted price. Again, it depends on what style of trader you are. But for people that are long-term traders, it's honestly a good time to just go in and buy more and get discounted price. Anybody that has certain long-term positions, is the best time to just go ahead and do that. I would also like to add that crashes usually don't last that long. They are often swift and violent. Once they're over, the market tends to go ahead and head back towards where it fell from, but how long it takes to get back there varies. If we look at last year, some companies recovered from the COVID crash like this, and then some companies, they still haven't recovered. They're getting there, but they still haven't recovered. But again, crashes are also when people make the most money. Like, I started investing once the crash happened, so it was easy for me to start accumulating growth because I picked up stocks after the crash. I would also like to point out a lot of people in the stock market gain the most wealth from picking up stocks after or during a crash. So that's good stuff to know. Now I want to go to the computer and I'm going to show you guys a little bit about what I saw these last 2 weeks during this crash. Some spots that I seen were impacted the most and where I seen were quote unquote safer than other places to be. Alright, so let's go to the computer. Alright guys, so yeah, we're looking at my Robinhood right now. Today was an ugly day in the market. Really ugly day in the market. The week has been ugly, about 5%. Month been good. The month has been good. But you see, it took a drastic fall. It was up pretty good, 10% for the month. But then, as you guys can see, the market has been slightly crashing. So, yeah. But what I wanted to show you guys that I noticed was that if I go to SPHD, SPHD is my low volatility dividend ETF. It's a monthly paying dividend. What I would like to show you guys is for the week, before today they were up, but for the week they're still positive. All right, for the month they're positive 2.33%. You know, so that's pretty good. And I do want to let you guys see this too, that of course with it being a dividend, low volatility, this looks like it's drastic, right? It's not. It's not. When it comes to these dividend ETFs, this didn't even drop $1. So it looks violent. It looks violent, but that's not even $1. It didn't even lose $1 value, you know? So that's what it looks like with some of these dividend ETFs. And I'm gonna show you guys another one just to show you guys can see I'm not just on SPHD to show you guys this. This is the Vanguard High Dividend Yield ETF. And if we go to the weekly, it's the same thing with them. It's a dividend ETF for dividends. But they had jumped up earlier this week, just like SPHD did. And then they're going down, but that is not even 1%. They're down, but it's not even 1%. So dividends, as I said, they are these dividend ETFs. I'm using the ETFs because I could go to a dividend stock by stock, but it'll take too long. The ETFs are easier to show you because, of course, they are a collection of dividend stocks. So a dividend ETF, it might not move as high or as rapid as a growth stock, but that's why dividend ETFs are safer than the typical growth stocks and growth ETFs. All right, so that was 2 dividend ETFs, and if I go to every dividend ETF, you're gonna see the same thing. Like with the Schwab dividend ETF, go to the weekly, you see the exact same thing. So it's 3 dividend ETFs, and they're all doing the same thing. They're dropping, but I mean, it's not much of anything that they're dropping. Now, let me show you guys one of them high growth ETFs. We're gonna go straight to the most popular one, ARK, ARKK. This is just for the one day how heavy they drop. For the week, ARK is down 17%. That 17% is $26.13. Again, on a lot of the dividend ETFs, they barely dropped $1, $1 or $2. But this ARK ETF is high growth. If you know about ARK, ARK is in all of the newer companies that are about to hit the scene and are supposed to explode. So this is what I wanted to show you guys, that with these high growth ETFs or high growth companies, because again, the ETF is just, I'm using the ETF because it can show you what most of the growth companies are doing. ARK is in a lot of the growth companies, and they're down almost 20% for the last week. For the month, they down. Them dividend ETFs, the dividend stocks, they were green. So anybody right now that are more so into dividends or got a portfolio that's more heavy on the dividend side, ETF or the stocks, they are winning opposed to people that are doing the growth. And that's why I wanted to point out that when a crash happens, growth stocks get hit harder than dividend stocks. Dividend stocks don't move that much up or down. They move, yes, they will go down for a loss, but they're not as drastic as when a growth stock takes a hit. I'm gonna show you guys another ETF just to make sure I'm not just picking on ARK right now. SPY-G, I own some of SPY-G, SPY Growth. Of course, they are not as on the newer companies as ARK is. That's why they're losing too, because they got growth companies, but they're not losing as heavy as ARK because ARK has a lot of newer growth companies. You go to the month, they're losing 2 on the month. I just wanted to show you guys that so you can see where the safer companies are and safer places are to be when you hear talks of a crash. Because growth stocks, they are great when the market is doing good. They're growing, they're going up, they're going to the moon, as people say. And then if it crashes, it's going to go straight to the dirt. Go straight to the dirt because they're growth companies. They go up high and they come down high. A dividend company or ETF or fund, they might take a hit, but it's not going to be as drastic as a growth company. So yeah, guys, that was just a quick run through on stock market crashes and what you can do during the stock market crash. Everybody has their own style. For a day trader, a stock market crash might just mean you just got to go ahead and get up out of a lot of your positions early because you're not planning on long-term holding anything. Because if you do hold on to certain companies during a stock market crash, understand who knows when they will recover. So they may end up being long-term positions that you didn't really mean to have. So if you fall into that, maybe you should just sell, cut your losses, and keep moving. But if you are long-term holding some companies and it's some companies that you really like, they're at discounted prices and you can average down on your position. So it's just all about where you are as a trader and your emotions, how you're feeling. But me, I'm going through, again, you guys know I'm a long-term investor. So I'm buying up certain companies while they're on discount. That's what I'm doing. But you guys definitely do what fits your style. That's why I talked about different styles in one of my other videos. Because it all depends on your style. Like I said, everybody isn't comfortable with making things long-term positions. And like I said, you never know how long it's going to take for it to come back. But all the options are there. Just make sure you don't get emotional. You think rationally about your decisions before you make them. That's just some of the options you have. But number one, stay calm. Stay calm. If you like any of the content in this video, please hit that like button, subscribe to the page, and come back and see me. I got plenty more to talk about. Thanks.